Hello everyone, this video is part of the BearNBull feature series. We are going to talk about the portfolio CAPM graph. CAPM stands for Capital Asset Pricing Model. This is one of the most famous asset pricing models out there. I am here at the BNB Invest portfolio page. The first section is our graph section. I'm going to click on the CAPM tab right above the graph, which takes us to the CAPM graph. The x-axis here is beta, a measurement of systematic or overall market risk. Y-axis, it's returns as a percentage per year. The assets in our portfolio are represented by blue dots. If we hover over the mouse, we can see the value of the metrics. There's also a red dot representing the portfolio itself and its metrics, and these are based on the current target allocation for the portfolio, which we've set on the targets table. So I'm going to scroll down to the table section. Here's the targets table, and we see the current target allocation for the portfolio. It's important to say that we are considering historical data when calculating expected return, risk, and all the metrics on this table and also on the CAPM graph. So we can set the span of time that we want to consider on the two input fields below the targets table. When we calculate, information on the table is updated and the graph is also regenerated. I'm going to scroll back up to the graph. We also see the security market line going from the risk-free asset with a standard deviation of 0, going through the market asset, in this case, total US equity market. This line is very important because it gives us a reference for what return to expect for an asset or a portfolio based on its beta, its level of systematic risk. We can see that some assets are positioned above this line, some are positioned below the line. For assets positioned above, we can say that they're delivering more return than we would expect for its beta. Therefore, we see a positive alpha, and we could say that the asset might be undervalued. For assets positioned below the security market line, they're delivering less return than what we expected for its beta, therefore negative alpha, and they could be overvalued. But this is not the whole truth. There could be other factors other than overall market risk that are responsible for this difference in returns. So you should always look at the R-squared metric. For an R-squared closer to 1, a lot of that difference is represented by the beta and systematic risk. So you could say more certainly that the asset might be overvalued or undervalued. For R-squared closer to 0, there seems to be other factors involved, so you couldn't be so certain about that. We do add a comment here on the upper left corner of the graph with a quick assessment for the portfolio itself. This graph is important not only to tell us if an asset might be overpriced or underpriced, but to assess level of systematic risk in our portfolio and for its assets. There's a lot to discuss about the theory behind what you see here on this graph. I do encourage you to take a look on the video section, we have a whole series about the financial theory behind BearNBull, and I'm sure you would get a lot out of it if you did watch it. I hope you like this feature. If you have questions, just send us a note.